Hello everyone, and welcome to the Jordan River Financial Education Channel. Here, we're on our journey out of financial bondage and into our financial promised land. At Jordan River, we practice financial accountability, and we ask you to do the same. Understand the risk around trading stocks and options before you trade. Don't trade with money you can't afford to lose, and don't take what you see here as financial advice. In this video, I'll be walking you through my trades in Arista Networks, symbol ANET. Arista Networks is in the technology sector and the computer systems industry group. The company provides hardware and software solutions to other companies involved in AI and cloud computing. Starting in mid-February, the stock started on a downtrend, pulling back to $60. In early April, the stock reversed and went on an uptrend to about $100 or so. From mid-May to about late June, the stock consolidated in a range of $85 to $100. The stock started its current uptrend in late June. After a good earnings report in early August, the stock gapped up and traded in a $130 to $145 range. On Wednesday, September 10th, the stock broke out of a volatility squeeze on high volume. I love these types of setups since they often lead to higher prices. With this setup, I saw myself as having three choices. The first option would be to buy the stock and participate in any upside that would follow, but I was a bit hesitant to do this since I was not prepared to lay down the $15,000 needed to buy 100 shares. Option 2 would be to buy call options. This would increase my leverage and require a much lower capital outlay. However, I was not comfortable with the higher likelihood of losing my entire investment if the stock did not rise to the required level by the expiration date. I decided that option 3 would be best, to sell a put option at the $150 strike price. This would give me a couple of days to come up with the $15,000 needed to buy the 100 shares of stock. I would also get paid about $425 to wait. If the stock ran up without me, I got to keep the $425. This wasn't bad for about 2 days of very little work. If the stock reversed and pulled back, then I could buy back the put at a loss, or get the put assigned to me at $150 per share. I could then set up a stop loss order on my stock. Which option would you have chosen? Let me know what you think in the comments. To execute this plan, I sold to open one Arista Networks September 12 $150 put, and I was able to sell this for $4.25. This gave me a net credit of $424.34 after commissions and fees. With this cash in my account, I monitored the price action of the stock through the end of the week. Well, Thursday, September 11th brought some follow-through on Wednesday's breakout. The stock opened above $150 and ran up to a high above $156. The stock then reversed, only to close at around $153.50, yielding the doji candlestick. That should have been a sign that selling would continue into the following day. On Friday, September 12th, the stock opened around $150 and continued selling off all day, closing near the low of around $139. The stock closed near the 20-day moving average, which had been weak support throughout the latter half of August. And that sell-off was also met with twice the average volume. If that support level did not hold, then the next level of support would be $130. This was previous support from mid-August. It was also the approximate value of the 50-day moving average, which is the thick red line on the chart. I was not willing to ride the stock all the way down to that level. My premise was that the 20-day moving average would hold as support. The current value of that level was $138.58 or so. If the stock fell to $136, then I would know I was wrong, so I placed my stop at that level. So where did this leave me? If I add up the $424.34 I took in from the sale of the $150 put, the $15,000 I paid for the 100 shares that I was assigned, and the current value of the stock being at $139.39, this totaled to a net loss of $636.66. If the stock hit my stop loss level at $136, my maximum loss would have been $975.66. So when I took a look at the other two options that I had when I first entered the trade, I was actually not in a bad position. If I would have purchased 100 shares for $150, then I would have been down $11 per share, or $1,100. And if I would have purchased call options at that price, those options would have certainly been worth next to nothing by then. The plan of the following week was to hold the stock, selling a covered call to bring down the cost basis. Over the next week, the stock bounced off the rising 20-day moving average and ended the week at approximately $150 again. At this level, I was approaching resistance, so it was a good time to sell an out-of-the-money covered call again. I chose to sell to open two Arista Networks September 26th, $157.50 calls. My order was filled at 75 cents. The strike was about 5% higher than the current stock price, giving me some room to run and still take advantage of the upside. I was okay with my stock being called away at that level, since this would have net me an additional $750. I had to go out 2 weeks to get the 75-cent price, and I was okay doing this. After commissions and fees, I was left with a credit of $148.67 to my account. So at the end of this week, as of September 19th, I was able to recover from the losses incurred the prior week. The stock price essentially moved back up to my purchase price. So the profit I had essentially came from the options trades I made around my core position of 100 shares of stock. This is why I love this method of trading. The stock can move against me and I can reduce the amount of losses I take. The stock can move sideways and I can still make money while I wait for the stock to move up. Arista Networks consolidated in a $140 to $150 range for the next week and through the end of September. As was the case in the middle of the month, the rising 20-day moving average was acting as support. The consolidation was indicated by the tightening of the Bollinger Bands. The lack of volatility was the reason for why options prices were relatively low at this point. I thought there could be another week of this consolidation, so I said let's make some money while I wait. I chose to sell another covered call. This time I went with the October 3rd $152.50 call. Since the stock was relatively close to the strike price, the price of the call should not be so low. I sold this call for 80 cents with only 2 days until expiration. Again, not bad for very little work over 2 days. So as the month of September came to a close, I managed to dig myself out of the hole regarding my trade in Arista Networks. After initially being down around $1,000 or so, I managed to make an unrealized profit of $500 by selling options. With my stop loss set at $136, I still stood to lose almost $750 on this trade if this level was hit. However, this too was an improvement over the $975 loss that I stood to take in the first days of this trade. Again, this improvement was due to the options trades I made over those weeks. I'll continue to manage this trade over the coming weeks, so I hope you'll stay tuned and follow me on this journey. I thank you for watching my first video, and please stay tuned for part 2, which will be uploaded soon. And I welcome your comments and constructive feedback. Please add them in the comments, and I'll get back to you. If you are interested to see how this trade works out for me, please consider subscribing to my channel and hitting that notification bell to be alerted of my next upload. Please also share with your friends and loved ones if you think they would be interested in this type of content. I plan to start including my other trades in future videos, so be on the lookout for them. Until then, may God bless and keep you all.